an equity perspective on our holding out for a rally panel up here. So now let's see if our Bad to the Bonds panel can be the real hero and give us an insight into the fixed income perspective. So markets have really hit us with its best shot this year, but Wamco, you're a real tough cookie with a long history of providing great active management in the fixed income space. So how have the increases in rates and most recently the volatility in the banking industry affected the economy? And how are your fixed income managers currently managing their portfolios, Travis?
Sure, thanks. So certainly it's been a wild year last year, and with the Fed hiking rates as aggressively as they have, you hear central banks talk about monetary policy acting with long and variable lags. And certainly we saw the impact on these rate hikes first and foremost in rate-sensitive parts of the economy, such as housing. But now you're starting to see that trickle into other parts of the economy. Now most people, most consumers, most businesses don't have a ton of floating rate debt, don't have to refinance on an ongoing basis. But certainly as that starts to happen and companies and consumers are forced to refinance at higher levels, that's going to take more of a bite into spending power and certainly earnings from a corporate standpoint. So I think we're starting to see some of those impacts on the economy. Some of the recent data, whether it's JOLTS data, you're starting to see some job openings decline a bit. Job growth is slowing, and you're starting to see some slowdowns in parts of the economy. So I think this is starting to have an impact, and achieving the Fed's goal of bringing down demand and getting inflation in check. And we have seen some more positive data on inflation recently, whether it's CPI or PPI most recently. So I think that will continue, and I think even with this this banking turmoil that's happened recently, I think banks are already tightening their lending standards. And this will certainly exacerbate that, and just access to credit will be a little bit diminished. You're going to see just more caution from corporations and consumers. And I think you're going to see that, again, slow down in hiring. That should continue to kind of bring down inflation as well. So I think it's starting to have that impact on the economy. We're not worried about a severe recession, but certainly a slowdown is warranted, and it could be a technical recession. We're not worried about a deep or severe recession, but certainly you have to be prepared for that. And so that's what we've been doing from a fixed income standpoint, is really being very, very active from a duration, from a yield curve perspective, and from a sector allocation standpoint. So again, this is one of those times where being active, we think, is incredibly important.
Awesome. Yeah, I know we heard a perspective on the equity panel, so it's great to hear Western Asset's perspective as well. So Pete, Prudential puts out a lot of white papers and webinars about their fixed income outlooks. And after last year's down market for both equities and bonds, it seems like there ain't no mountain high enough, ain't no valley low enough, and ain't no river wide enough for us to hide in a market like this. So what is the team's fixed income market outlook, Pete?
Well, first thing, I send you a ton of stuff, all
Yes.
of our white papers and webinars. You want me to continue sending them? You're still good?
Oh yes,
Okay.
I love
So
getting all those emails.
PGIM is absolutely prolific when it comes to writing white papers. And here's, for any advisor in the room, and I've been there, I come from the consulting side, you come from the consulting side. If you're on your way to a meeting and you're expected to give some market commentary and you're at a loss for ideas, when you get in the parking lot, type in our website, you will find stuff about equities, fixed income, tips, commodities, target date funds, and everything in between. So trying to add value right from the get-go. In terms of our market outlook, I would say the one thing that's constant is change, and it's evolved. And we've got one big idea that we've been talking about for a while, and that's we've been in the lower for longer camp, right? We actually wrote a paper a few years back called The Low Ranger. And essentially, you could boil it down and distill it down to one idea, and that is demographics or destiny, right? If you look at the entire developed world, right, the United States, Japan, Europe, and China, every single population is aging. It's actually getting smaller, and you're seeing growth slow. You're seeing consumption slow. You're seeing all of those aspects of the market essentially bringing down and serving as an anchor on growth, serving as an anchor on rates, and essentially creating a natural bid for bonds, right? Because people get older, they de-risk. So this has been our overarching philosophy, but more recently, some of those ideas have changed, right? You have to actually be in the here and now. That's our long-term philosophy. There's the old John Maynard Keynes line, like, in the long run, we shall all be dead. What's going on right now? Well, I can tell you this, in the beginning of the year, we were extremely optimistic, super optimistic. First things first, a little tidbit that you can share with your plan sponsors. Every single year since the history of the ag, that any year that's been negative, the next year has been positive. Every single year, except for last year. This is the first time we've had 2 consecutive negative years in the ag. So that is a starting point. We were super optimistic. The consumer, highly, highly resilient, right? Even in spite of everything that's been thrown at them, super resilient. The labor market, right? I don't think I have to tell you, anybody that goes to a restaurant, right, the service isn't good and they're saying help wanted, they're apologizing in advance. The labor market's strong. You're starting out with a 7% yield in some of those core plus portfolios. Right from the get-go, you see inflation starting to roll over. Everything looks like an ideal setup for a great market, right? Does everybody agree? Does that sound like a pretty good setup? And then a month and a half, right? A month and a half ago, suddenly those regional banks started to have issues. And again, that outlook changed again. So we are less optimistic. We still think it's going to be a good year for bonds. We still think it'd be smart to get into a core plus portfolio. But we're less optimistic, and we think that there are some risks on the horizon. What are those risks? First things first, we haven't been overwhelmed or blown away by the government's response, right, in terms of shoring up the banks. So that's number one. And of course, you never discuss politics, particularly in California, but I think everyone here would agree it's not a bipartisan environment, right? It's a little bit polarized. What are the odds that they come to an agreement on the debt ceiling, right? So that's another one. We still have a war, as was mentioned in the earlier panel, between the Russians and the Ukrainians, and there could be a broader conflagration across Europe. So there are still some risks, and I think as those risks evolve and as those risks change and our thought and our outlook changes, the portfolio has to change. And frankly, that's really a core tenet of active management, which I think is going to be kind of a theme for all of us, and the benefits of active management, particularly in fixed income.
Awesome. We'll get into a little bit more on that active fixed income perspective later in the panel, but over to Steve. We've started to see the inflation areas cool, which some of our panelists have already mentioned, but with everything going on in the banking sector and with the Fed under pressure, will there be another rate hike, and what do you think the Fed will do for the rest of the year?
Well, I mean, so I don't completely agree with my good friend Pete here, that prior to the banking crisis, that everything looked great, right? I mean, I think that was just a big tumor that had exploded based on a free money environment for 7 or 8 years. But the greatest predictor over the last 18 months of what the Fed's plan has been is just to read the notes, right? They've given us a very clear path of everything that they're going to do and have done. The problem is nobody believes them, right? Nobody believes that the Fed really is going to raise and then hold and wait for inflation to come down and then cut. And so it's really this mismatch, and then we're also living in this bizarre environment where bad news is good news and good news is bad news and nobody knows what to believe. And everybody is just kind of waiting for that one major indicator that the Fed's going to cut or the Fed's going to hold or the Fed's done raising. I think the consensus, and people in this room know, I think it's 66% chance of a 25 basis point hike in the next meeting. And then there's, I think, 3 cuts baked into the futures now before the end of the year. So I mean, you just have to think about that world that you're living in, where you're going to raise 25. They're obviously trying to cool inflation. I mean, that's like they're not to be political, but like when you have the Democrats in office, their number one thing is going to be inflation because it affects the lower income people. But what happens if we kind of devolve into this economic recession where all of a sudden, or a potential stagflationary environment, and so then they're forced to cut probably more than they'd like to. So they're really in a difficult position. So to answer your question directly, read the Fed minutes. I mean, they're pretty much telegraphing everything they're doing. The problem is that nobody believes them, right? And I think people are starting to believe them now. And I think some of the next few economic indicators are really going to give a good idea of what the end of the year is going to look like. And looking 6, 9, or 12 months out, I think is the hardest part for anybody's job. I'll probably spin my wheels in a couple questions, but like a lot of it is just it's the market is a very long-term kind of a history lesson, but we're all trying to be forward-looking, and I just think we don't know what some of that economic data is going to tell us.
Awesome. Well, we've now heard 3 perspectives. Let's turn it over to Franco and see what T. Rowe Price's outlook will be. So what's T. Rowe Price's market outlook for 2023? And we've heard some of the macro data that we should be looking for, but what does T. Rowe Price think?
Absolutely. So T. Rowe Price does not have a house view, so that's where I kind of come in and kind of put all our views together. Listening to our U.S. economist, she's in the camp that there'll be another 25 basis point hike on May 3rd. June is a question mark. There's potential for another hike. It's really looking at the market, looking at that resilient labor market data that was mentioned, and looking at inflation. So the theme this year isn't shocking. It's really the Fed, inflation, and recession. So we think the Fed is pretty much at the end of the hiking cycle, which is why we have such a great title, Bad to the Bonds, because yield is back, right? And that's why fixed income should have a very strong year, a coupon clipping year this year. When we look at inflation, we think inflation will most likely be around that 3% by the end of the year. Headline inflation is coming down significantly, but we're looking at more at core inflation, and more specifically, core services ex housing inflation. Why this particular area? Like as he said, that's what Jerome Powell told us to look at. That's what he is looking at. They've changed the indicators they've looked at since they've started their hiking cycle. First, it started with financial conditions, then the University of Michigan Consumer Inflation Expectation Survey, then the 3-month Treasury yield versus the 3-month Treasury yield 18 months from now. You can look at any forward curve of fixed income. No one really looked at that curve before. The New York Fed looks at the 3-month yield versus the 10-year yield. Now we're looking at this very specific part of core inflation. What is in this metric? It's transportation services, recreation, educational, medical care. Realistically, what do we translate that to? The employment market and wage gains. So we're looking at core services, ex-housing inflation, and more importantly, we're looking at the non-farm payroll numbers. We've had a very, very strong, resilient labor market, which we think will start to turn over and possibly go negative by the end of the year, leading to a recession. We do not agree with current market pricing of 3 cuts by the end of this year. We do think the Fed will hold. On average, historically, they'd hold for about 6 months. So perhaps they will hike in May. June is a question mark. We'd put at less than 50% chance. Perhaps that first cut could come in December, in January. The big question mark is the tightening of lending standards. However, when the Fed does cut, we do think that the Fed will cut a bit more aggressively than the market is expecting.
Awesome. Thank you for T. Rowe's perspective on that. So I'm going to go back to you, Pete. PGIM is the sub-advisor on the Core Plus Bond CIT that is available to all of you RPAG members out there. So we just heard about some of those perspectives out there and some of the outlooks and opportunities in the fixed income space. So Pete, don't go breaking our hearts. Bonds should take the weight off of us. Has 2023 knocked on your doors and given you the key to more opportunities in these plus sectors?
Well, I would say this, right? Plus sectors, and let's define plus sectors, right? First things first. Most people, when they think of a core plus strategy, those plus are high yield, emerging markets, to a lesser extent, some structured product, right? And they are an incredible tool, right? That's where if you allocate to them smartly when the time is right, that's what's going to get you your alpha. That's what's going to get your juice. It actually could mean the difference, and I'll probably get into this a little bit later, but you're talking big differentials in terms of returns, right? But I would say the most important thing that you can think about when you're hiring any core plus manager is for them to know when to use those plus sectors, right? It's a double-edged sword, right? If you just sort of capriciously invest in them and you think that this is a free ride, oh, I'll just put some money in. Actually, we saw nobody on this panel, thankfully, but many of our competitors out there thought, hey, look, free lunch. I'm going to put some money in some high yield, some EM. What could go wrong, right? What could, like the mad guy. What could go wrong? Well, we can see what went wrong, right? You can see big losses, and again, it is a double-edged sword. And we talked about those swirling risks, right? The risks of, again, broader war in Europe, the debt ceiling, right? So that's coming. The risk of recession, which before was sort of a remote risk, at least that's what our economists thought. And now we're saying it's not a if it happens, it's likely to happen. It just depends on the severity and the duration of it, right? So right now, we're essentially we're using the lowest amount of our risk budget that we've had since I've worked at PGIM, which is close to 10 years. So we've got roughly 10% of our portfolio in those traditional plus sectors, EM and high yield. But that doesn't mean we look like the ag, right? We are paid to generate alpha, That is our goal. And looking like the ag just isn't going to get you there. So we've been investing in different parts of the plus market, right? Things like CLOs, AAA rated, default remote. I mean, you need a 5 standard deviation event in order to see any losses in these things, right? They are AAA rated and they are liquid. Non-agency RMBS, super high quality, highly vetted CMBS. So really, we're moving the whole portfolio up in terms of credit, and there's a reason for it. Because we talked about those swirling risks. Those are risks, but they're also opportunities, right? It's like I don't know, it's sort of a cliche, the Chinese character for crisis and opportunity are the same thing. I don't know, I don't speak like Mandarin or Cantonese, but there is opportunity in any sort of crisis. So when you look at the plus sectors that we're investing in right now, you can almost say that we're biding our time. We're being patient. We're looking, and when that event occurs, when there's that catalyst, because they're so liquid, that's going to allow us to strike when the iron's hot. So, as I mentioned, there are opportunities. You are getting a nice carry in a lot of those plus sectors, above and beyond treasuries. You're getting it with AAA rated securities that are highly liquid. And then when that opportunity comes to us, we're going to be able to capitalize.
Awesome. So it sounds like PGIM portfolio managers are tumbling out of bed and stumbling to the kitchen to pour themselves a cup of ambition and working 9 to 5 to differentiate their portfolios and find those opportunities in the plus sectors. So
that's what I was thinking.
Yeah. So Pete, I'll stick with you. How is the Core Plus Bond CIT positioned in this current environment? And why should advisors use this strategy now when I swear sometimes that Fed is out to get us?
Well, I would say this, right? I kind of already mentioned how we're positioned, and that is we've de-risked the portfolio. Again, we're in traditional core strategy with those plus and super liquid CLOs. I won't sound like a broken record here. But one of the things you mentioned is why invest now? And what I would say is, for all the advisors in the room, again, I was on that side of the table for a long time. That's how I started in this business. You never buy a core plus strategy, or really anything in a 401k, for now, right? You buy it for the next 15 and 20 years. And obviously, I hope that when you run your finger down your list of clients, they all have PGIM, Core Plus, TRB, CIT in them. But the way you vet a Core Plus manager, and you think about why investing in it now, has more to do with how is that manager over the long run, right? Because we've all been, I know you've been in this situation too. A manager's not doing well, you replace them, you replace somebody else with someone else, and that manager was just riding that last factor wave, and then you wind up having to replace them, and then in 2 years, the client says, who recommended that fund? And you have to raise your own hand. Like, that's an embarrassing situation. You don't want to be in that situation. So how do you select a Core Plus manager? And for those of you who were here last year, I'll abbreviate it. And this is an analogy that I use. It's somewhat silly, but I think it works. And that is, you have to think about it like a chef, right? A chef, in order to make a good meal, you need great ingredients, and you need somebody who knows how to use those ingredients in the right proportion at the right time, right? So let's start with ingredients, right? What are the ingredients of a good Core Plus strategy? High yield, EM, corporates, govies, floating rate, structured product. I mean, you're talking about the whole myriad, right? So one of the little cheat sheets that you can do is go, hey, look, does this asset manager, who we're going to trust our assets with, how do they do? Do they have an EM strategy? Is it good, right? Like, let's look at PGIMs. Is it good? Yes. They're corporates. Yes. They're govies. Yes. They're floating rate. Yes. They're high yield. You go down that list. So then you have an idea. You have a sense. Do they have good ingredients? Do they have good bones, right? Can they actually do it? But then the question is, do they have the ability to invest in those different sectors at the right time, in the right proportion? And that's when you got a cheat sheet too. You can just look at the attribution. And over the last 20 years, you've got global financial crisis, you've got the Greece looked like it was going to blow up, you've got COVID, you've got wars, you've got a myriad of opportunities to look back and say, how are they at mixing those different sectors at the right time, right? And what I can tell you is this, I just gave you the cheat sheet. You can do it, or you could choose not to because the RPAG team has already done it for you. I think I could probably tell the amount of due diligence, research, ongoing due diligence, they know the portfolios better than me, and I work at PGIM. They know exactly the allocations, and they know everything about the portfolio. They've done all the vetting for you, and they've also negotiated great fees. So that's how I would think about selecting Core Plus, but it's not for today, it's for the next 20 years. And you want to find somebody who has that consistent, conservative, repeatable, and durable process over that time period.
Yeah, Pete brought up a good point. We don't only put them on the hot spot up here, but we have regular ongoing investment due diligence calls with all of our underlying CIT managers and all of our products and any one that we recommend. So good point, Pete. So moving over to Travis, Western Asset, Prudential's not the only Core Plus bond manager in our CIT list, so Western Asset also is a sub-advisor on the Core Plus Bond 2 CIT. So I'll offer the same question to you, Travis. Has the recent environment provided more opportunities in these plus sectors? And how is Western Asset taking care of business to differentiate themselves right now?
Oh, absolutely, and I think that in this kind of environment where you kind of have these different outcomes that people are looking at. It was just a few weeks ago, actually, people were talking about, inflation's going to be sticky, the Fed's going to go higher for longer, a 6% terminal rate. That was the risk at that point. And then you have an environment more recently, is the banking turmoil going to turn into a banking crisis? Is the Fed going to have to cut rates aggressively? So you have these different outcomes. No one knows for sure how it's going to play out. So you need to be a little bit more, we believe, a little bit more defensive right now within some of these plus sectors. Now our high yield team, our bank loan team would say they feel the fundamentals there are really good. They're investing in companies that can handle a slowdown, can handle some earnings compression. But when you look at how we think about the total Core Plus fund and putting together these different pieces, we have to be thoughtful about what is that total risk and what is that volatility going to look like. So we still believe areas like high yield bank loans make a ton of sense. We have been trimmed some of that just given the potential for a harder landing, which we don't necessarily isn't in our base case. We have to think about what are the different scenarios that can play out. EM is an area that we have liked for quite some time. Emerging markets is one of those areas of the last 6-7 years. It seemed like every year, like this is the year for EM, whether it's fixed income equities, and there was some issue that kind of hit it head on. We think the long-term outlook for emerging markets is really good, and especially when you look at plus sectors, you're talking about in many cases local currency EM, buying bonds denominated in the local currencies where yields can be 8, 10, 12%. And you get that currency component. And people talk about the strong dollar last year. That was really the dollar strength against a lot of developed market currencies, the yen, the euro, where many EM currencies actually appreciated versus the dollar last year. So having exposure to areas like Mexican peso, Brazilian real actually drove some excess returns in our Core Plus portfolio. Because one of the main reasons was a lot of these EM central banks actually started to raise rates much more aggressively than developed markets. They started raising rates in the middle of 21, getting ahead of inflation, and getting to a point where they're now on the opposite side of this and can start cutting rates fairly soon. And so you have many of these countries, not all of them, but many of them have very independent, professional central banks giving us comfort there. And again, you look at the long-term secular outlook for emerging markets, they have higher growth potential. They have better demographics, younger workforces, lower debt to GDP than many developed markets. So we think pockets within EM make sense, but again, you've got to be tactical. When do you want to take that exposure? When do you think you're getting paid for that? Or do you think an environment with a lot of geopolitical uncertainty, an aggressive Fed, that's a period where the EM generally underperforms? Let's get a little bit lighter on that. So there's really opportunities in plus sectors. Just like PGIM, we have diverse teams, really deep and experienced teams in all of these sectors. So we feel very comfortable, very confident moving around in all of these different areas where we see the best opportunities. And again, it's not just the traditional plus sector, you said, just looking at non-benchmark areas and looking at things like structured products, non-agency residential, non-agency commercial. Obviously, there's a lot of issues with commercial real estate today, so you've got to be really specific about what exposure you're taking there. Also, areas like TIPS, which are not in the ag, it could be a useful tool to put on a hedge against maybe higher inflation. So again, we feel a Core Plus strategy, certainly that Western employs, using all of those different tools, all of the different kind of sector allocations, as well as very active from a duration and a yield curve perspective. We'll take a view not only from sector allocation and issue selection, but using a lot of these top-down macro strategies, having some active duration, taking a position on yield curve. So again, we think that plus sectors and non-benchmark sectors can really add a lot of value, but you've got to be thoughtful about sizing those positions and being very active about when you want to take more risk, and certainly, when you want to hedge some of that out.
Awesome. Yeah, we've heard from both equity and fixed income managers on the emerging market side and how inflation has already peaked there and that rates are starting to decline in emerging markets countries. So it's interesting to hear your perspective. You answered this question a little bit, but I'd like to get specific on it since it does sound like WAMCO is a big active manager. So does active management on the fixed income side still matter? We saw a disastrous 2022 last year, so I don't know if we should dream on, dream on, dream on.
I think when it comes to active versus passive, there's certainly some sectors that do make sense to go passive. I think when you look at fixed income, and there's been a lot of studies on this, that active generally beats passive in fixed income. You think about what a passive benchmark is in fixed income, you have more exposure to the most indebted issuers. So you're getting exposure to the people that have taken out the most debt. And is that really what you want? You are a forced buyer as names enter the benchmark. You're a forced seller if they drop out of the benchmark. And you're really reliant on rating agencies. That defines what your inclusion rules. And not to say that those aren't valid, but we want to have more of a view on credit quality, not just within the ratings. And I think you look at the long-term studies, and just the median active manager net of fees has consistently outperformed the benchmarks. So we feel, if you go passive in fixed income, and especially in areas like the ag, you're kind of leaving money on the table. That most active managers can generate excess returns net of fees. And so this is an area that again, you certainly want to be thoughtful about where you're taking these active positions, what sectors make sense, which ones don't, and which markets are inefficient. We think markets are generally inefficient. That's especially so in fixed income. You think about how many uneconomic investors there are. You have central banks and governments that were forced buyers of treasuries and sovereigns, massive amount of purchasing of agency mortgages. That was a market you want to be out of when the Fed is buying all of the current production and driving spreads extremely tight. You want to take an underweight position. Now what's happened is the opposite, right? The Fed is stepping out of that market. Mortgage spreads are widening because of the Fed stepping out and because of just rate volatility is higher. That pushes mortgage spreads wider. So that's a time you want to be adding exposure. So a lot of inefficiencies in markets in general. We certainly think so on fixed income, and we think active still makes a ton of sense. Last year was rough for fixed income no matter what, whether you're active or passive. The only safe place to be was in cash or just no duration at all. But again, the starting point here is really, really much more attractive. Yields we haven't seen these yields in kind of 10, 15 years, right? So the ag is yielding 4.25. Your active core plus managers yielding probably 5.5. Go into IG credit, you're 6.5, and high yield and bank loans, you're probably 8 to 9. And even if you assume, in high yield and bank loans, you will have some losses, right? There will be some defaults, but we don't see a big uptick there. So even if you assume kind of your loss adjusted returns, you're still looking at probably 7% or so. So a lot of areas within fixed income that make sense here, and we still think active certainly beats passive in fixed income.
Still lots of opportunity to take advantage of those inefficiencies out there. This is ground control to Major Steve. I'm going to move over to Lord Abbett now. Lord Abbett, you advise on the core bond CITs.
Yep.
So while you don't ignore plus sectors entirely, how does your team balance an allocation to those sectors? And what are your views on duration right now and why?
Yeah, so we don't ignore plus sectors at all, right? I just think we just have a different view in this particular portfolio on our risk budget. I mean, internally, our process across all of our fixed income products generally, they're all multi-sector by nature, right? So we don't want to, as active managers, ignore any opportunity that we see on a relative basis if there's relative value. And in times of stress like we have now, and I was talking to one of our PMs on the flight out here, like there's just like disconnections where there may be a spread sector where historically we might have applied a higher beta to our risk language, right? Because they just tended to be more volatile. But we're just seeing tremendous value there, and we're seeing kind of forced selling in that space. So when we look at our core bond portfolio relative to like a core plus, which is another variable that we also manage, we kind of take that macro view. We kind of identify relative sector based on what we find to be the most attractive sectors within that portfolio, and then we just want to do it in a very measured basis where we can provide an experience, particularly in a retirement plan, that's just more consistent and a little bit more, a little less volatile than what a plan participant may think he or she is getting involved in. And then when it comes to duration, like you mentioned, we've never really been a big duration house, and I know there's firms that do it really well. Our view is, we have one of the largest fixed income research teams in the world, and all these little tiny decisions, and I think in our core bond fund, we have 600 CUSIPs. Every single one of these little decisions that we make can be wiped out by one bad guess on rates, right? So rate volatility is very difficult. If you get it right, you can shine. But I think, especially from a risk-adjusted perspective, when we're trying to apply kind of a more predictable return stream for a plan participant, and nobody likes to create work to the advisor or to the research team here at RPAG. We really think in this particular portfolio about information ratio, about Sharpe ratio, and about just consistency of performance. So if we can, we're never going to be top decile. If we are, we're not doing our jobs right? Like we really want to be top third, top quartile on a consistent basis. I think the portfolio's been around since 2000. We beat our benchmark 21 out of 23 years, which we're very proud of, right? And I think it's just from our fundamental credit research, probably our apprehension, which some would argue we're kind of leaving a tool in our tool belt by not really taking big duration bets, but particularly in terms of retirement plans, we just think that gives us the predictable return stream that plan participants would expect with a core bond portfolio.
Awesome. Well, I'm going to shift over to my three little birds over there, T, Rowe, and Price. You pitched up on FlexPath's doorstep singing sweet songs of partnership and launched the Wilmington Trust T. Rowe Price Retirement Series last year. Now, don't worry about a thing, because this is the same series as the T. Rowe Price Retirement Series. RPAG members now just get offered lower expenses at no minimum requirements. And I do see some FlexPath innovators out there, so if you have questions about that series, feel free to grab them at the happy hour. So Franco, with bonds seeing their worst calendar year performance in 2022, and just hearing about the opportunities in fixed income, does T. Rowe plan to make changes to the fixed income allocations within the target date funds?
So if you take a look at the allocations in the target date funds, we kind of optimized it and expanded the tool set in 2017. So if you take a look, we've heard a lot about the US aggregate index. So there's a core fixed income allocation, and that fixed income allocation, 70% of the allocation in 2017 was going towards that US ag in our new income fund. At that time, we decided to make a change and sort of broaden our horizon because the tool set has expanded. And I'm going to tie this to how this performed last year. So with that, we sort of cut down that exposure to 45%. We added the possibility to go into international developed market bonds, either hedged or unhedged, up to 15%. We've also added a sleeve for long duration treasuries that typically have that ballast in the portfolio, that negative correlation that was not there last year. The other area that we did in the core allocation is go into what we would consider a non-traditional bond fund. It's able to earn negative duration from 1 year to 6 years. It's primarily a government bond fund with hedges, whether those hedges are on currencies, FX, interest rates, certain parts of the credit markets. That portfolio, one of its main purposes is to have negative correlation, the S&P 500, to the US high yield index, to the US ag and emerging market hard currency dollar denominated debt. That portfolio, Dynamic Global Bond Fund, was one of only 2 funds here in the US that have greater than $1 billion in assets with a positive return last year. So we still had that ballast in the portfolio, we just expanded the opportunity set. And we also took advantage of some of the plus sectors that you've heard from my colleagues up here on the panel. We've actually increased our allocation to floating rate loans. So we know bank loans, high yield part of the market, but we pride ourselves on our credit research, and that's an area where you can generate income. So our strategic allocation increased from 2% to 3% in that space. And looking at performance, that was pretty much flat last year, which was a good return in a very challenging fixed income market.
Awesome. So I'm going to stick with our asset allocation discussion and move over to Steve here. The FlexPath Cash Balance CIT allocates a portion of the fund to the Lord Abbett short duration bond. So short-term rates are high relative to history, so those funds should be walking on sunshine right now. So what job do short duration bond funds play as a part of an asset allocation, or just simply as a standalone fund in a lineup versus, let's say, a stable value?
Okay, there's a lot of questions there, so I'll try to. All right, so there's finally income and fixed income, right, which I think is like music to all of our ears up here. Short duration, I think, eliminates some tail risk from our perspective, or in an asset allocation perspective. Our short duration product that is inside of that cash balance fund, we do prefer to pick up yield, and the reason for that is just default rates tend to be less on shorter duration materials. It's a lot of yield to call paper, and so you don't have as much price volatility as you stay on the short end of that curve. And then if you pair it generally, whether in an asset allocation model, with like an AG as an example, or some sort of a core plus strategy, in almost every scenario that we run, it adds Sharpe ratio to that mix. As it relates to stable value, because we sub-advise in stable value, not for a product here, but I'm pretty involved in that business too. Like that's a capital preservation. Like we're trying to, guideline compliance, kind of downside protection is extremely important. I think the benefit of a short duration income portfolio, which is which is used in the cash balance fund, is there's a target return they're trying to hit, and it pairs nicely when you're just trying to deliver some predictable yield with not a lot of default risk, and then you can pair that with some either equities or some more stable fixed income, because there's really not a big advantage to shooting above your target return. There's a disadvantage to shooting underneath it, but short duration income or short duration credit tends to fit nicely in some more of these predictable target return portfolios.
Awesome. So I'm going to throw the last question over to Franco after this crazy little thing we call 2022. What are your thoughts on bond benchmarks and the inefficiency of the fixed income markets?
So you've heard it before, the bond market, the bond markets, the benchmarks are skewed by the largest issuers of debt. If we just go back to the U.S. aggregate index, what's it made up of? U.S. Treasuries, U.S. agency mortgage-backed securities, and investment-grade corporates. Investment-grade corporates are only 25% of that benchmark, but it makes up about 80% of the risk bucket. So you can see that bond benchmarks are incredibly, incredibly skewed to largest issuers of debt. And then in terms of the inefficiencies in the markets, you've heard about the inefficiencies. A lot of bonds don't trade. It's a somewhat a illiquid market, depending on the sectors that you're in. When you look at those inefficiencies, there's opportunities to exploit those inefficiencies. So we went back and looked at historical risk-return ratios. And where are some of the most efficient part of the fixed income markets? It's the front end. It's that short duration, 1 to 3 year. The best part of the market, short duration investment-grade corporates, 1 to 3 year. But at T. Rowe Price, we expand that opportunity set, and we look at 1 to 3 year government bonds, 1 to 3 year emerging market, US dollar denominated investment-grade bonds, 1 to 3 year agency mortgage-backed securities. So there are opportunities to sort of exploit the inefficiencies in the fixed income market and really take a look at those bond benchmarks, because the weightings show one aspect, but the risk weightings are a bit more important than just looking at what's actually in the benchmark.
Awesome. Well, I did have some encores queued up, but I do see the SOS from the timer. So, Mamma Mia, here I go one last time with trying to stick to this music theme. You all have been super troopers throughout this panel, and I want to continue to have the time of our lives out there. So this Dancing Queen signing off, but thank you for the music, and thank you for all your time, and thank you to our panelists.